Welcome to the Deep Dive. We sift through some really intriguing stuff to bring you knowledge you can actually use, and maybe some surprising insights along the way. Today, we're doing something pretty unique. We're pulling back the curtain on how some of America's most, well, enduring wealthy families manage their money. Think dynasties like the Hiltons. How did they not just make their fortunes, but keep them, protect them strategically? Our mission here is simple. Cut through the noise, pull out the core ideas from Mark Miller's book, Hilton Wealth. We want to give you a kind of shortcut to understanding what people call smart money investing. These are principles usually, hidden from the average person. Expect some surprising facts, some solid takeaways that might just change how you look at your own financial path.
And that really is the heart of it. We're not just listing what these families do. We want to explore why these strategies work so well, why they last. The book really tries to show how a different way of thinking about building and keeping wealth can help you invest like an American dynasty. It's about getting those foundational principles, not just chasing the latest market fad.
Okay, let's unpack this. And the origin story is fascinating. Picture it. 1949, Conrad Hilton. He's the patriarch, the visionary behind the Hilton Empire, and he makes this incredibly bold move. He buys the Waldorf Astoria in New York.
Which sounds iconic now, but back then, his advisors thought it was incredibly risky.
Right. But Conrad, he saw something different. He saw opportunity, a symbol, luxury, sophistication, a key piece in building a global brand. J. Bradley Hilton mentions this in the book's foreword. Conrad's success really boiled down to three things. First, seeing value where others just saw problems. Second, spreading investments out, reducing that risk.
Diversification, but maybe on a grander scale.
Exactly. And third, always keeping an eye on the big picture, building something solid, something meant to last generations.
And what's amazing is how Conrad's vision just perfectly lines up with this whole smart money investing idea. This isn't the usual retail approach most of us know, buying public stocks, bonds, at whatever the market price is.
Right.
Smart money investors, and we're often talking people with maybe $200,000 to $50,000 or more already invested. They get access to a much wider world of assets, and often at lower costs too. It's not just the money amount. It unlocks networks, opportunities.
An advantage most people just don't see.
A distinct advantage, yeah. Lets them cut down risk while aiming for potentially better returns.
Okay, so this is where it gets really interesting for me. A huge part of this smart money thing is using alternative investments. We're talking private equity, hedge funds, advanced private real estate plays.
Stuff you don't usually find on the Main Street brokerage account.
Exactly. Imagine investing in a startup before it goes public, or owning a slice of some specialized commercial building throwing off income, or finding a high-yield income stream that has, built-in safety nets.
These are tools institutional investors have used for decades.
And the book talks about synergistic investing, which sounds fancy, but it's basically not just diversifying, but strategically mixing unique assets and different strategies so they work together.
Like enhancing each other, managing risk as a whole system.
So why are these alternatives so key?
Well, they open doors that just aren't there in the public markets. Private equity lets you get in early on a company's growth, almost like being a founder.
Okay.
Hedge funds. They can use strategies, some complex ones like short selling or derivatives, to try and make money whether the market's going up or down.
So less tied to the overall market direction.
Exactly. And advanced real estate isn't just buying a rental. It's about structures designed for steady income, maybe even inflation protection baked in. This whole approach, layering these different things, helps build what the book calls a financial fortress.
Makes sense, a fortress. Beyond the investments themselves, though, another big edge is access to top-tier talent and resources. These investors aren't trying to figure it all out themselves.
Boy.
They tap into this huge network. Brilliant minds, cutting-edge research, teams doing deep dives, due diligence.
It's like having your own personal, incredibly smart research department. Gives them a massive edge.
And that ties into something else you mentioned.
The long-term mindset.
Yeah.
It's absolutely critical. Just like Conrad Hilton, successful investors aren't chasing quick wins or panicking over daily news headlines. They focus on quality, on strong foundations, and they hold on. Patience, discipline.
Avoiding those impulsive moves driven by fear or greed.
That's a huge lesson right there for anyone trying to build real lasting wealth.
Okay, so we've seen how a legacy like the Hiltons got built. Now let's poke at a strategy many of us learned, maybe even still use. Does it actually get you to financial freedom today? Let's talk about the rise and fall of the 60-40 model.
Yes. The old standard.
Right, proposed by Harry Markowitz back in the 50s. 60% stocks for growth, 40% bonds for safety. It's balanced, right? Sensible.
And it was, for a long time, it really was the cornerstone for many portfolios. But the book makes a strong case that the 60/40 model is, well, pretty much obsolete now.
Obsolete. Why?
Market conditions have just changed so drastically. We've got volatility like we've never seen before. Plus, interest rates have been scraping the bottom for ages.
Makes it hard for that 40% in bonds to do its job, cushioning things or generating income.
Exactly. Bonds aren't providing the safety or the returns they used to. And the book points to some painful examples, like the dot-com crash in 2000. It mentions a client, John, who followed the 60/40, lost 62% of his portfolio.
Ouch. Wow, 62%.
And we saw it fail again in 2008 and even in 2020 during the initial pandemic shock. So it really begs the question, if that old gold standard isn't reliable anymore, what is a better way? How do you manage risk effectively now?
That's a really powerful question, especially since, like you said, so many people might still be using that model. So if 60/40 isn't the answer, what does a truly resilient portfolio look like? This is where the book introduces something called the true wealth portfolio approach. It's built on 4 distinct investment buckets.
Designed for stability and growth, working together.
Okay, bucket 1, the guaranteed safety bucket. What's in there?
Think rock solid. U.S. government securities, savings bonds, FDIC-insured bank accounts, things where your principal is essentially 100% guaranteed, the foundation.
Got it. Pure safety. What's next?
Bucket 2 is the guaranteed income bucket. Here, the focus shifts to generating steady, reliable cash flow.
How?
Through things like guaranteed interest notes, basically debt instruments with a fixed return dividend paying stocks, maybe some high yield bonds, certain types of REITs.
So a bit more risk than pure safety, but focused on income.
Precisely. Robust income potential.
Okay, 2 down, bucket 3.
That's the market risk bucket. This is where you get your growth engine. Blue chip stocks, growth funds.
There are traditional equity investments.
Right, but typically managed by top-tier institutional managers, experts navigating the markets trying to optimize returns within this growth sleeve.
And the final one. This sounds like the differentiator.
It really is. Bucket 4, the private equity alternatives bucket. This taps into those less accessible areas we talked about.
Venture capital, private equity deals, direct investments.
Exactly. Potential for really outsized returns here. But what the book highlights, and this is interesting, is the idea of surety, often built into these deals within certain networks.
Surety.
It means they structure deals often with some form of collateral, like an asset pledge, to protect the initial investment. Adds a layer of security you don't always find in private markets.
Okay, so it's not just high risk, high reward, there's structure.
There can be, yes. And this whole multi-bucket system, it creates this truly diversified, resilient portfolio. It's designed to handle different economic weather.
Like a ship with watertight compartments. One area might take on water, but the whole thing doesn't sink.
That's a great analogy, and it mirrors Conrad Hilton's adaptability, right? He didn't just stick to railroads, he saw cars coming and built hotels on highways.
Anticipating change, adapting, not just sticking to old models.
Exactly. This portfolio structure tries to do the same for your investments.
Okay, fascinating stuff on the investment side. But let's switch gears a bit. There's another huge piece of the puzzle, often missed by regular investors, but absolutely vital for the ultra-wealthy.
You must mean taxes.
Exactly. Judge Learned Hand had that famous quote, "In America, there are 2 tax systems, one for the informed and one for the uninformed." And when you think about it, taxes are probably going to be your single biggest lifetime expense. You have to pay attention to this if you're serious about wealth.
Absolutely. It's critical. And the ultra-wealthy, the Hiltons of the world, they don't see taxes as just filling out forms once a year. For them, it's like a complex game of chess, highly strategic.
A chess match. I like that.
They work with top-tier tax pros, advisors, structuring everything for maximum tax efficiency. It's not just about what you make.
It's about what you keep.
Precisely. And using sophisticated planning lets them legally minimize their tax hit, often dramatically.
Now, there's this common fear, right, that if you start using fancy tax strategies, you're just painting a target on your back for an audit.
That's a persistent myth, but it's largely unfounded if done correctly. The crucial difference is between tax avoidance and tax evasion.
Avoidance is legal, evasion is illegal. Big difference.
Huge difference. Tax avoidance is simply using the tax code, as written by Congress, to your advantage. The code itself provides these opportunities.
So how do they do it legally? The book mentions three main ways.
Right. First, just strictly following the IRS tax code itself, knowing the rules. Second, understanding case law.
Meaning strategies that have already been tested and upheld in court?
Exactly. Legal precedent. And third, looking at private letter rulings. These are specific IRS responses to taxpayer requests. Often big players like, say, Hilton might seek one.
And even though they're private initially, they become public.
Yes. Sanitized, but public. They offer clues into how the IRS interprets certain complex situations. It informs strategy.
So using these legal tools, does it actually reduce audit risk?
Counterintuitively, yes. A well-structured, formalized tax plan built on these solid legal grounds actually reduces the chance of an audit significantly. The book says 9 out of 10 cases.
Wow. So it brings up a good question for listeners. Are you just being proactive, doing the basics, filing on time, or are you doing advanced tax planning?
There's a massive difference in the outcome.
The book uses this great analogy to illustrate it.
Yeah.
The sparrow and the eagle.
Mm-hmm.
The sparrow is proactive, busy, gathering twigs, doing the necessary stuff, but mostly reacting to what's right there.
Head down, focused on the immediate.
Right. But the eagle, it's strategic. It soars high, sees the whole landscape, thinks moves ahead. It uses the terrain, the tax code to its advantage. It structures things not just for now, but for the long haul, for generations, playing the game at a completely different level.
That's a perfect description of the mindset.
And it's not just theory. There's a case study in the book, Rochelle, a business owner, making about $1.25 million a year.
Okay.
With standard tax approaches, her projected tax bill over 10 years was $3.75 million. Pretty hefty chunk.
Like significant, yeah.
But using these advanced smart money tax strategies outlined in the book, her tax bill dropped by 80%.
80%.
Yeah. Saved her $2.9 million over that decade. Her total tax ended up being around $850,000 instead of nearly $4 million.
Think about what that $2.9 million could do for her business, her family, her legacy.
Just by being informed and strategic about taxes, incredible.
And Rochelle's story really feeds into this bigger concept, maybe the ultimate secret weapon, the family office.
Right, the family office. Where did that idea even come from?
It actually goes back to John D. Rockefeller, turn of the 20th century.
The original Rockefeller.
Original. He had all these top experts, CPA, lawyer, real estate guy, but he realized they were all working in silos, not talking to each other, no unified strategy.
Sounds inefficient.
Very. So he had this light bulb moment. Create one dedicated team, the first family office, to manage everything comprehensively, like having a personal CFO for the family's entire wealth.
A single holistic view. Makes sense.
Ensures everything works together strategically.
So what are the big benefits of a family office today?
Huge benefits. Deep personalization, access to really cutting-edge, often exclusive strategies, and that multi-generational planning focus we talked about, ensuring the wealth lasts.
But that sounds incredibly exclusive, like only for billionaires.
Traditionally, yes.
Yeah.
But the landscape is changing. The book discusses how modern virtual family offices, like the one associated with Hilton, the Hilton Family Office, or HFO, are bringing these kinds of services to a wider group.
Wider group meeting.
Specifically, they mention folks paying around $25,000 or more in combined federal and state taxes annually. Technology and networks make it more accessible now.
So democratizing that high-level advice.
Right.
What does a virtual setup like the HFO offer?
Well, the book details quite a bit. Access to a massive network. They mentioned over 800 elite tax pros, attorneys, money managers, all collaborating.
Wow, that's a deep bench.
Right. Peer-reviewed solutions. Over 540 dynamic strategies they can draw on. Plus, things like financial risk reduction, getting into those alternative investments via their exclusive network.
The tax mitigation we talked about.
Exactly. Portfolio optimization, wealth transfer planning, even concierge services, help with cybersecurity, a private plane network. It's a whole ecosystem.
A complete financial quarterback, basically.
That's a good way to put it, bringing every piece of the financial puzzle under one strategic roof.
Okay. So after diving into all of this, what's the big takeaway for our listeners? We've gone through smart money investing, rethinking risk with low volatility approaches, the power of advanced tax planning, the family office model.
These aren't just interesting theories. These are the tested, proven methods that families like the Hiltons have used for generations to build and protect serious wealth.
So the question becomes,
how could your financial future look different if you started applying some of these smart money principles? Even just starting to think differently. What kind of legacy do you really want to build? For yourself, for your family, maybe even beyond?
it really makes you think. The path to lasting wealth, true financial freedom, it probably isn't about chasing the next hot stock tip or just accepting the status quo. It seems to be about vision, about taking strategic action, and maybe having the wisdom to unlock doors that you thought were only open to a select few. So the final thought isn't really if you can build your own version of an American dynasty, but maybe how determined are you to find your own path towards that kind of lasting prosperity?